Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, April 18th, 2019. Wanted to do a quick overview, an update of the markets, and also follow up on the sectors of the S&P 500. In recent weeks, I've been starting to pick up coverage of those sectors, and if there's the reason, what's prompted me to do this video today is I'm finally, for the first time in quite a while, starting to see technicals play out. What I mean by that is there are certain sectors and certain stocks that are now clearly, breaking down, playing out, bullish or bearish. We have bullish and bearish, ideas I've been sharing in sectors we've been looking at lately. But up until recently, we were seeing the same thing that we saw back in throughout 2017 and leading into the early 2018 highs. If you remember, in January of 18, we had a blow-off type top. And what was happening then is due to the indexing effect, which there's been many articles written about it. I've talked about it, where in past decade, there's been a tremendous movement from actively managed funds, meaning mutual funds and hedge funds, people that are good old-fashioned stock pickers, to just simple indexing. Whether institutions are doing it, pension plans, individuals, it's just been massive. So what that's created is that huge, what I think, and even Jack Bogle, the inventor of index funds, who recently passed away from Vanguard, even he had his concerns about it. It's too much. And so what we saw is the unwinding of that back in the correction in early January, in late January of 2018. We had a couple pretty sharp corrections earlier that year, and also at the end of 2018, and we saw the same thing. We saw everything rising in tandem leading up to the October highs in the market last year, and then boom. You saw what happens when there's a rush for an exit on an overcrowded trade, when there's too much money crammed into just a handful of stocks, because when you index, you buy those top components, receive the lion's share of the money coming in. So when the tide turns, it goes the other way. And again, so you saw what happened. So now I've been seeing that recently, but in the last couple weeks here now, especially with this earnings season kicking underway, I'm seeing some charts that are playing out for what they are, and that's why I want to do this video. And so who knows, maybe we'll see this play out as well, this steep wedge, these divergences on the indexes. So let's just start out with QQQ. Nothing new, but again, we're sitting precariously close to that trend line right now, and it would only take a gentle push to get us below there. And what you want to see, again, you want to see the floodgates open. You want to see impulsive selling, a solid daily close, and you want to see it on as many indexes in market-leading stocks as possible. The more, the better. So if you start to see everything, all the big stuff going down at once, and you might be able to get a jump on a short entry trade there before waiting for a daily close. Oh wait, let's go to XLK. All right, so the point of this video was to do a sector analysis. I'll get into the 11 sectors of the S&P right now. Before we do that, let's just look at the S&P 500. I mentioned yesterday the S&P 500 actually broke down, and it printed a red candle close below. Another red candle so far today. So this is definitely something to watch. However, as I said, and I've been saying for a while, said it back last fall, until tech breaks, the market won't break. Because tech is the market. It is the largest sector of the S&P 500, and it is also by far the largest sector of the NASDAQ 100. So here's XLK. Tech is looking a little bit better. It's got a little bit of room between its current prices and the uptrend line. So certainly you might want to keep an eye on this one. Replicate the chart or the trend line. I'm using log scaling, not arithmetic. You'll get a little bit different picture. See how the candles change on arithmetic scaling, and there's log scaling. So that's you're pretty much capturing all the reactions from the lows on December 24th, getting the bottom of all the candlesticks. That's where I have that trend line right now. And again, you might be able to get a head start. This is a 60-minute chart of XLK, and what you can see is a nice fairly well-defined trend line. Enough reaction, certainly. You can see coming back here from late March. Here's your divergence line. Again, this is more important. This is the one that triggers a sell signal. Divergences can be changed. This could morph into a price channel, look something like this. You could, extend the divergences, even take them out. But as of now, we have pretty clean divergences. PPOs crossing down. So we could be looking at go time here any day now. And this, again, may be an early trigger, because if this breaks, and let's just assume this pattern plays out, I don't see a lot of support. This would be my first target down here. But what happens, more importantly, should that occur, that would be a almost 2.5% drop to that 75.28-ish target. What that would do is give us a breakdown on the much more significant daily chart here. So let's see where we're at from right now to get to that trend line. If we did it today, yeah, we're only about 1% above that trend line. So again, this is more important. This one could break down. This is a 60-minute chart again. This has been the story of 2019 so far. 60-minute charts, beautiful wedges, divergences break down, and what they do is they either hit their minimum targets and the market continues higher, or they even reverse shy of that. Whereas in a normal market, I look at this wedge, I'd say, yeah, we're probably coming down to this target here. But remember, now we have, even this minimum target would take us down below that trend line on XLK. So these are the things I'm watching. Remember, the market is simply a sum of its parts, and I take a holistic approach. My analysis, even if I'm only trading, let's just say tech or QQQ or NQ, I'm going to watch everything. I'm going to watch the S&P 500. I'm going to watch healthcare. Might not put as big a weighting on REITs and utilities, but I'd like to watch all the sectors, particularly the market-leading stocks, because they'll determine where the market goes. So that's XLK. Let's move on to the next one. That's the largest sector in the S&P 500, almost 20% weighting. And then we have, of course, XLV. I believe that's the second largest weighting at about a little over 15%. If you recall in recent videos, I spent a lot of time on it on the March 28th video, the S&P 500 sector analysis video. And on that one at the time, I was focusing a lot on the weekly chart here. And this is just a beautiful chart. I mean, we go back all the way to the lows in 2009 right here. This is our bull market uptrend line. And this, by the way, and I said it at the time, it's just I referred to this as just a beautiful chart. I look at sometimes I might be a little geeky in that aspect. I love technical analysis. I love, this is to me like a painting. It's just a masterpiece because it's a very clean, well-defined trend line. Lots of reactions along the way, not just one reaction here and a few right here. You have reactions back here, their initial reaction, that reaction from the flash crash there, more reactions. And so on a scale 1 to 10, this is close to a 10 for a trend line. This is just well-defined. And again, that's what I said back at the time. Let's take it down to a weekly chart. And so what we had is a breakdown of that trend line. And I said if this pattern was on any time frame, if it was a 15-minute time frame, I would trade it for a short-term trade. If it's a daily chart, I'd trade it for a swing trade. But this is a weekly chart. So this is something that indicates to me healthcare is just started a major leg down. It started when it broke here. Well, there was the top. You had an impulsive breakdown, a back test, and at the time, again, that was a few weeks back on the 28th of March, I said the only thing missing now, the only thing we need to see, because we have a breakdown and a back test, is XLV to start moving down impulsively to get an impulsive rejection, and that's exactly what we had in the last few days here. So far so good. Work to be done always, because we need to take out that previous reaction low. I've identified some, if you want to, if you're short or you want to gain bounces or whatever, 80, 77-ish, call it 81, first target there, and then 76. And that would be another, from where we're at now, about a 10% drop. And I would put good odds that that gets hit in the next couple months here. Could be quick, could be in the next few weeks. We could also get a little bounce before then because we had a lot of stocks. I'll get to XLV here in a second, but we had a lot of stocks hit support yesterday. See, XLV, and when I covered on the daily chart, here's a minor trend line there. It's actually, that trend line would extend back to the 2009 lows, and there's your breakdown, back test, and just nice and clean. Finally, we rolled over, a little impulsive shot down there, kicked back up, and boom. And so yesterday we closed a little below that 82.62, which was my first target. And there was and still is a potential that this may be what I call a momentum fueled overshoot. It all depends on what the market does. If the market can continue higher and not break down right now on those levels I showed you on XLK and QQQ, then we could snap back up here and regain that level, maybe consolidate it around it for a while. Again, a momentum fueled overshoot is when you have a lot of velocity heading in a downtrend heading down. You tend to overshoot a support level, even if it's going to hold, and then you'll snap back and hold on it and maybe even bounce a little. So there's that potential, but right now we're moving a little bit away from it so far this morning, and that just means that opens a door, if we can't recover it soon, to the next level here and then down here. And this would really be a swing target. This is probably the most significant support level, the strongest support level on this chart. So I'll color code that for you guys if you want to see where before all said and done in the next few weeks, whether we get we'll probably have a counter trend rally somewhere along the way. But that's another, let's see here, another 6% downside to that level. You can see the reactions there. So that's XLV. And again, I've spent a lot of time on these first two because they're the highest weighted components. Let's just go through some of the rest in no particular order. These aren't the highest weighting, or this one's not, but XLRE. In those recent videos, I told you the two of the most bearish sectors out there, or a few of those besides the healthcare stocks, were the REITs, and right here, and again, shame on me for not, I mentioned this several times, is a nice looking setup, and I actually told you SRS was under consideration for an official trade. It was in this bullish falling wedge. Sorry guys if I transition too quick, I know I'm talking fast. If you missed the other videos, SRS is a 2-time ultra short REIT ETF. So it's IYR in reverse. IYR is the REIT sector ETF. You can do DRN or DRV. Those are the 3-time leverage. But keep in mind you have a lot of decay in those, or you can. Either way, SRS is pretty liquid as well. And now we've already hit my first target. Broke out. And it broke out the other day, but it had run up so fast by the time I pulled up the chart. Didn't have a price alert set. I thought I did, and so kind of missed the entry on it, and it's just not given us a way back, a second chance pullback or back test to get in. But again, it was laid out in advance. Hopefully some of you caught it, and I think I did see in the trading room some have. But you can see there from the breakout so far, this thing has rallied 6-7%. So here's how you're beating the market: is security selection right now. There are, and more importantly, again, I want to impress the point here that we're finally seeing some charts play out. I don't lose my faith in technical analysis just because the broad market continues to grind up. Everyone's buying tech stocks; it won't buckle. But we don't have to trade the broad market, and it's nice to finally see that sectors within the S&P 500 are not moving up right in line with the market. So we're starting to see things play out for their own, on their own technicals. The REITs are certainly one of them. So there was that little wedge that broke there. That's really that SRS wedge right here in reverse. I just showed you SRS. When you take an inverse ETF, you're going to have where you have a bullish falling wedge on SRS, you'll have a bearish rising wedge on IYR. There's the breakdown. Here's a potential trend line. We could chop below that. But I still think this one, before all said and done, heads at least to this level here. So I do think there's more downside left there. So there's the REITs on breakdown. I already showed you again XLV, the second largest sector, clearly off its highs, clearly coming under impulsive selling. And again, on that weekly chart I showed you, regardless of the zigs and zags, I see a lot more downside in the healthcare sector. Let's cover some other ones real quick. XLU I mentioned is one of the more bearish looking ones a while back, right here when we had a divergent high, and you can see that's played out. We had when I started highlighting it here, it was back testing. That was right here. Back testing, came back down, hit this target here, the support level 57.26, and that's an important level. Why? Well, it was a breakout of all-time highs right here, at least multi-year highs, and it was, so we had 1, 2, a double top, triple top here, but it punched above there, made a successful back test, went up, And this is why I say I don't chase breakouts to new highs or all-time highs when you have divergence and overbought conditions. Because if you read the simple textbooks and technical analysis, they'll tell you a breakout to all-time high is very bullish. Why? Because everybody at that point in time is profitable. There's nobody underwater. When you're at a 52-week or all-time low on a stock, everybody's underwater. Anybody that's owned it, nobody's profitable. And likewise, at an all-time high, everybody's profitable. At least nobody's underwater. So, and this is also a bear trap. If it fails now, that's the thing. This, on face value, to those that see it that way, bought it. And now if we drop below there, that's that WTF moment for them. And that's what a bull trap is all about. So let's watch this level. If we go much below there, sometimes you come and back test a level, you move through a little bit and then continue up. But if that fails, that is a big fat failed breakout to new highs and a bull trap, and not good. Now, utilities aren't going to rock the S&P 500. They're only about a 3% weighting, but again, it's a potential trading op. And if you want to leverage it up a little, they're relatively low volatility. SDP is a 2 times short utility ETF, so there's a potential trade. Not one of my favorite, only because we're at support right now. You have no sell signal at all. It's not a false breakout yet. It's just a back test, but it's potential. Just something to keep an eye on and kind of gauge where the market might be heading. Energy, well, energy depends on oil, and I don't want to get too off track, but they go hand in hand. Somebody asked me the other day about XOP, whether to go long or short. I think the next trade in XOP and the energy stocks will be a short. I just need to see. This is USO, the crude oil ETN. We need to see crude breakdown. It hasn't done so yet. Overbought. Last time it was overbought was right here. So here's what happened to people that chase oil and believe that oil is going to the moon when you're buying it at overbought readings. And again, if you go back in time, it's just simple stuff. It doesn't mean that it can't go up. Sometimes overbought becomes more overbought. But if just look at where the RSI was at each of these instances, your risk reward is lousy. Why go long? Why stay long? Or at least you can stay long. That's the thing, because overbought. But what you need to look for are uptrend lines or key support levels, and then set a stop. So if you are long and this one happened to want to do all this, maybe it comes in and it breaks. I'm just again going back in hindsight. Maybe it would have broke the trend line here. So maybe there was another 5-10% left. Didn't turn out to be. But a well-placed stop will keep you in a trade that's going with the trend, but also so it'll allow for more profits, but also prevent you from being holding on to the trade and getting married to it. Because when this dropped, I imagine that very few thought that crude could fall so much so fast, and it can happen again, and it could happen just with the broad market as well. So we'll see. All right. So that goes back to the energy sector, and again, when crude breaks, the energy sector breaks. So that's pretty simple there. You can see a similar type wedge. Industrials, XLI, let's see, you have now, since I did the last video, it looks like we didn't have a divergent high. Now we do have a divergent high. It is not a confirmed divergent high. It is what I call potential divergent high. Why? Because the PPO, which is a momentum indicator, is pointed higher. So, as long as it's pointed higher, it could keep going higher, could take out those divergences. But watch for a reversal. We just popped that previous high. Reversal would turn these indicators down, confirm that divergence, and it could send XLI lower, and probably would. Now, bigger picture, this is and has been, nothing has changed from the longer term picture since we broke down last quarter. Nothing at all. I see these long-term bull market uptrend lines. I see impulsive breakdowns, a big leg down, which looks like the initial leg down, and just a simple kickback rally. And the fact that the S&P 500 or Nasdaq has come at or near, I didn't even pay attention yesterday where they popped the all-time highs. That is irrelevant to me, because the stock market again it's not just a handful of those market-leading FANG stocks which have lifted it. This is the economy. This reflects what's going on in the U.S. economy, healthcare, industrials, all these other companies, and so they're clearly have broken down, and this one hasn't even come in for a back test yet. and it still could backtest and roll over. And even if it does, it'll make a new high. And sometimes that's how tops look. So that would technically prove to be, extend the bull market, if you want to say that, in XLI if we took out those previous highs. But if we reverse there and then headed down here, something like this, I mean, this is what that chart indicates. At best, we come and back test and then have the next leg down. Wave 1, 2, 3. You want to count a primary 5 count if you're an Elliott waver. Could look something like that. Wave 3 is the most powerful wave down in a primary 5 wave count. So we'll see. We'll see what that proves to be. But as of now, again, it's and we're still below the highs. And keep that in mind as I go through these videos, that the majority of sectors are still off their all-time highs. And so and other smaller caps and mid caps and things like that too. XLC, the new communication sector. Remember, this replaced telecom last year, and there's your downtrend line, broke above it. It's been in this kind of almost a price channel, close to being a price channel there. Divergence on the daily chart. We don't have a lot of charting history since it is a new sector that only came out in 2018. So you want to probably focus on a 60-minute chart or maybe a 120-minute chart, something like that. Kind of give you a better picture. What do I see right now? I haven't updated this one in a while, but I'll do it for you. I see a divergent high right there. And here's an example of what's gone on recently. There was a divergent high that played out for such a minor correction and even gave us a little failed breakdown. This is what I was talking about, how until recently this was a clean divergent high, a nice trend line. It goes back a little farther there. I'll show you that. No, not a great trend line, but it was one worth noting. You can see enough reactions there. Breakdown, and what did it do? It just proved to be a bear trap, and the XLC pushed higher. But at this point in time, here, this is probably the most important thing. We don't have a well-defined uptrend line. This would probably be the best fit I can give you for a trend line. Gives us a little price channel right here, but we do have divergence, and sometimes these little divergences can do the trick. So there's the levels to watch. There's a little gap right there, and we give you that. That would be support for XLC. I don't see a lot of buzz in the trading room about XLC. I don't think we have a lot of traders trading that, but it's worth watching because it is, again, one of the larger sectors within the S&P 500 at over 10%. All right. Oh, here's a big one. Two more. XLY, consumer discretionary. This is one of the few to break, and this market is unique. Every bull and bear market is different. The signature right now, or what's going on, the primary driver of this market, I know you guys are all going to think I'm going to say it's not the Fed. That certainly has plays into the psyche of investor sentiment and all that, with the Fed pulling a 180 last quarter. But I can tell you this: what's holding this market up, and I've said it in a recent video, the consumer. And there's three pillars, because consumer spending is 2/3 of GDP. Right now there's three pillars we need to watch. Any one or all of those break, the market will break. I guarantee you that. And that is the employment numbers, which continue. They came in better than expected today, the new unemployment claims. So we need to watch employment data. Right now unemployment is record low. There's a lot of job wanted signs, help wanted signs out, and that's good for the economy because everybody's employed. When you have a paycheck, you spend money, and that shows right here. Consumer discretionary, as the name implies, discretionary income. That's stuff you have when you meet the basics. The other one is consumer staples. We'll get to that in a second. Staples are things you need. Milk, eggs, deodorant, stuff like that you buy during whether times are good or bad. Discretionary, those are your big screen TVs and your Ferrari and things like that, your boats, yachts, anything else in there. And I know there's some companies in here that kind of fall into both categories. I think Amazon might be in there, but there it is. There's your wedge. Looks a lot like the market. Very overbought. No divergence on the RSI, but yet very overbought. And these overbought runs can go and go and go, but when you get extremely overbought in a one-sided trade, what happens are usually very sharp and fast corrections. And more importantly, we just watch the technicals. This thing can go all for the rest of the month, 2-3 more months, but we're watching this trend line just like we were watching this trend line right here. Nice clean wedge, and when it broke, that was our sell signal, and that sell-off didn't stop till right here. So let's watch that one. It looks a lot like the broad market. Here's a breakout to new highs, but you talk about an unimpulsive breakout, a non-convincing breakout. Look at those candles, and look at the volume. This is a breakout that odds favor it will fail. Breakouts that occur on above average volume, 1.5 times or better, have a much higher chance of sticking. Breakouts to all-time highs that occur when you're overbought like this have a much higher failure rate. The best case scenario for XLY, if it wants to go on, would be to come back in, fail this breakout, work off the overbought conditions, consolidate here for a while, and then break out when it's not overbought and we don't have divergences and things like that. Right now, the likelihood of this just continuing up another 10-15% before a meaningful correction, in my opinion, is very low. So there's a trend line to watch, and also a key sector of the S&P 500. And then finally, we'll cover XLP. Here's your staples. This is, again, the stuff you need, not the stuff you want. There's the trend line. I have this one drawn a little different. You can see I excluded that reaction there just because it has a much better fit. So there's the trend line I'm watching on the staples, XLP. Staples are running at, there's another sector that's still well off its all-time highs right there, back there in early 2018. And right now we have essentially about a double top from where it rallied up to last November. So here's your trend line, and that's what we want to watch. Here's your divergence line, still intact, overbought, and that's it. All right, so let's wrap it up here. And like I said, the takeaway that I'm seeing from this, a lot of these sectors, the majority that I just covered, haven't yet broken down, but we're in pretty close proximity to those trend lines. Look, this market can do whatever it wants. It can rally for another 3 or 4 months. So I'm surprised it's rallied as much as it has, but it doesn't mean that it's invincible. And again, to put it into perspective from where we're at now, if you recall, this was my uppermost bounce target. I had a bounce target range back then. Let's see if I have it on another chart. Well, that's the line. So we're less than 3% above where I expected the bounce to go. That was in my year-end update back in late 2018. It was a range, I think was just the range right here. Yeah, that was my range. So we're a little bit above it, but not by a lot. Just a few percentage points. And here's the thing: we're still within spitting distance of the all-time highs on the SPY. Maybe it wants to make a run at those highs. Maybe it wants to pop it, but again, it's just not, being long here, taking new longs that have a high correlation with the market, or index longs for that matter. To me, it's just a matter of picking up nickels in front of a steamroller. I said it here, and I believed it there, and again, 3%. There's just a lot more money to be made in other sectors elsewhere right now, in other individual stocks, both long and short. So I'll continue to do updates on the broad market, and we see clean, high probability entry. I can tell you anytime in the foreseeable future, the next entry that I put on any index shorts again will be, or index ETFs will be on the short side. The charts have a lot of work to do to change and flip to where I might be interested in adding those for long swing trades. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.